It's been a busy week for euro traders. Although the European Central Bank didn't give the market what it really wanted, which was a clear message on the terms of its current asset purchases programme, which ends in March 2017, traders did see opportunities to further short the euro for a third week of losses against the US dollar. As the uncertainties persist, analysts, traders and investors have started building speculations on QE engineering, taking Mario Draghi's silence regarding the end of the QE as a signal that the ECB will not end its asset purchases abruptly. But again, Mario Draghi didn't actually say anything to confirm nor deny. Of course, the selling pressure on the euro is expected to remain in place until the next ECB meeting in December, when the ECB committee will announce their update on economic forecasts. Hence, the markets are expecting the ECB to also reveal their plans on the future of their monetary policy. For the euro dollar, the 108.50 level or the 108 level is well on the radar, while the 110 mark is expected to shelter offers for traders looking to sell into upside corrections. We remind that the negative trend in the euro dollar is supported by both legs, ECB doves in the one hand and the Fed hawks in the other. Looking at major macro events on the agenda next week, traders will be watching the PMI figures due on Monday across Japan, Europe and the US. Now, while the PMI data is expected to generate little deviation in terms of forex trading, it could help the yen find a short-term direction ahead of Friday's inflation figures. The dollar-yen is looking for a breakout in either direction, depending on how bad the inflation data comes in. Now, the national CPI figure, ex-fresh food, is expected to have retreated by 0.5% year-on-year. A softer inflation figure could trigger a break above 104.65 for a further attempt towards 105, max 105.50. Now, short-term resistance is eyed at 103.15 before 102.89, which is a major 38.2% retracement. If broken, it could suggest a short-term bearish reversal. Now, on Wednesday, the Australian quarterly inflation will also be in focus. The Aussie dollar against the US dollar bumped into a solid midterm resistance at 0.7730 on Thursday, October the 20th, which was followed by a sharp profit taking that brought the pair down to 0.7620. Now, a faster than expected inflation figure in Australia could give further support to the Reserve Bank of Australia hawks and give a reason to retest 0.7730. If broken, it could take us to 0.7750 and even 0.7780, 0.78, which could happen next week. Now, finally, in the US, the core durable goods orders is expected to remain in line with last month, with a stable 0.2% increase on a monthly basis. Now, the US dollar could be subject to two-sided volatility ahead of the FOMC week and the US election. Traders should take into account a higher event risk in the US dollar for the month ahead, bearing those things in mind. Now, that's a quick wrap-up on the week ahead and some key technical levels on some of the major FX pairs. Make sure you do check out our analysis section on our website, which will keep you up to date with all the latest market news and technical insights. In the meantime, enjoy your weekend and see you at the same time next week. Goodbye.